What if I told you that you could retire on just $528,000 instead of the typical $1.25 million most financial advisors recommend? What if you never had to sell a single share of your investments to pay your bills? Today, I'm breaking down a controversial three-fund portfolio strategy that's currently paying 9.47% in dividends. But there's a shocking twist that could make or break your retirement dreams. Look, I get it. The traditional 4% withdrawal rule means you need $1.25 million to generate $50,000 per year in retirement income. But here's the thing. That rule assumes you're selling your investments every year, hoping they don't crash right when you need the money most. That's sequence of returns risk, and it's killed more retirement dreams than market crashes. But what if there was a different way? What if instead of selling assets, you could live purely off the dividends? I've spent weeks analyzing real data from 3 specific ETFs with a combined $43.9 billion in assets under management. These aren't penny stocks or risky investments. These are professionally managed funds that millions of investors already trust with their money. Here's the strategy that's got everyone talking. 3 ETFs, equal weights, 9.47% combined yield. Let me break this down. First, we have GPQ, the JP Morgan Nasdaq Equity Premium Income ETF. This beast manages $30.5 billion and is currently yielding 10.65%. But here's what makes it special. It's not just buying dividend stocks. JP Morgan is actively managing a portfolio of large-cap companies and using sophisticated covered call strategies to boost income. They're essentially selling insurance on their stocks to generate extra cash flow. The fund employs a two-pronged approach, combining an actively managed portfolio of large-cap U.S. companies with approximately 15% allocation to equity-linked notes that replicate covered call strategies. Trading at $57.10 per share with 107 holdings and a beta of 0.85, GPQ provides meaningful diversification while maintaining defensive characteristics. Second is DIVO, the Amplify CWP Enhanced Dividend Income ETF. Now this one's interesting because it's the smart kid in the room. Instead of mechanically writing covered calls on everything, DIVO's managers are selective. They only write calls on 20 to 30% of their positions, which means when stocks rally hard, they can still participate. It's yielding 4.60%. But as we'll see, there's a reason this lower yield might actually be genius. With $5.2 billion in assets under management, DIVO focuses on just 20 to 25 high-quality, large-cap, dividend-paying companies with strong fundamental characteristics. Trading at $44.37 per share, the fund's concentrated portfolio includes established dividend aristocrats such as Microsoft, JP Morgan Chase, and Johnson & Johnson. Finally, QYLD, the Global X Nasdaq 100 Covered Call ETF with $8.2 billion under management. This is the income monster, yielding 13.15%. QYLD follows a systematic approach to covered call writing that prioritizes current income over capital appreciation. The fund holds the constituent stocks of the Nasdaq 100 index while systematically selling at-the-money call options on 100% of holdings each month. Trading at $16.86 per share, recent monthly payments have ranged from $0.1598 to $0.1877. But here's where our story gets really interesting. So you'd think with yields like 10.65%, 4.60%, and 13.15%, this portfolio would be crushing it, right? Well, here's where 2025 data reveals the shocking truth that most dividend investors don't want to face. DIVO, with the lowest yield at 4.60%, has delivered 13.10% in total returns year-to-date. Meanwhile, QYLD, with that mouth-watering 13.15% yield, has returned just 1.20% for the entire year. Think about that. The fund paying the highest dividends has essentially gone nowhere, while the boring dividend fund with the lower yield has made investors rich. This is the dirty secret of high-yield investing that nobody talks about. Sometimes chasing the highest yield is like grabbing fool's gold. It looks shiny, but it won't make you wealthy. JPQ sits in the middle with a 9.26% return, proving that active management and smart strategies can find the sweet spot between income and growth. So why does this happen? It all comes down to how these funds actually work. Let me tell you a story that'll make this crystal clear. Imagine you own 100 shares of a hot tech stock trading at $100. QYLD's strategy is like agreeing to sell those shares for $105 to anyone who wants them within the next month. You get paid $300 up front for making this promise. But what happens when that stock jumps to $120? You still have to sell at $105, missing out on $1,500 in gains to earn $300 in premium. That's exactly what happened to QYLD investors in 2025 as tech stocks soared. The fund's systematic nature creates inherent limitations that become particularly pronounced during bull markets. QYLD's one-year return of negative 1.8% starkly contrasts with its high yield, illustrating how covered call premiums cannot compensate for forfeited upside participation during strong equity rallies. Devo's approach is smarter. They might only make this deal on 25 shares instead of all 100. So when the stock jumps to $120, they capture most of the upside while still earning some premium income. That's why Devo crushed QYLD in returns. Unlike systematic covered call strategies that write options on 100% of holdings, Devo's managers tactically write covered calls on only 20 to 30% of positions, allowing core holdings to participate more fully in market rallies while still generating meaningful option income. GPQ uses an even more sophisticated approach with equity-linked notes and active management, trying to get the best of both worlds. The numbers prove it's working. 10.65% yield with 9.26% price appreciation. Let's get into the real numbers because this is where rubber meets the road. If you need $50,000 per year in retirement income, here's what each approach requires. Traditional 4% rule. $1.25 million invested, selling shares every year and hoping the market cooperates. This three-fund strategy, just $528,000 invested, living purely off dividends, never selling a share. That's $722,000 less money you need to save. For most people, that's the difference between retiring at 65 versus 55 or retiring at all. But here's what really matters: the monthly cash flow. JPQ pays around the 4th of each month, Devo around the 30th, and QYLD around the 29th. You're getting steady money coming in every single month, just like a paycheck. No market timing needed, no selling decisions to stress about. With $528,000 equally split between these three funds, you'd be getting roughly $4,167 per month in dividends. That's $50,000 per year without touching your principal. The monthly distribution schedule across all three funds provides predictable cash flow that aligns with typical expense patterns, creating staggered income throughout each month that helps smooth cash flow and reduces the need for cash reserves. Now, I'm not going to sugarcoat this. There are real risks you need to understand. The biggest one is what I call the upside ceiling. When markets rally hard like they did in 2025, covered call strategies get left behind. QYLD's 1.20% return in a year when the Nasdaq soared proves this point brutally. The primary limitation involves capped upside participation during strong bull markets, with QYLD's modest performance serving as a stark example of this dynamic during a year when technology stocks have performed strongly. There's also concentration risk. All three funds are heavily weighted toward large-cap tech stocks. If the Nasdaq crashes, your entire income stream takes a hit. You're essentially betting that Microsoft, Apple, and Google will keep performing well enough to support these dividend payments. The fund's collective focus on Nasdaq 100 exposure creates sector concentration that may not suit all risk profiles, and geographic concentration in U.S. equities limits international diversification benefits. And here's the tax reality most people ignore. A lot of this income won't qualify for favorable dividend tax rates. You'll likely pay ordinary income tax on much of these distributions, especially from JEPQ and QYLD. That could eat 20 to 30% of your income depending on your tax bracket. Tax considerations significantly favor holding these funds in tax-advantaged accounts when possible, as option-derived income generally receives less favorable treatment than qualified dividends. Devo's higher proportion of qualified dividend income, approximately 46% of distributions, may make it more suitable for taxable accounts, while JPQ and QYLD are better positioned in IRA or 401k holdings to maximize after-tax income. The strategy works, but it's not a free lunch. You're trading potential growth for current income, and in bull markets like 2025, that trade-off can be painful. So if you're still interested in this approach, here's how I'd actually implement it based on the 2025 performance data. Don't go equal weight across all three funds. That's amateur hour. Instead, I'd suggest 40% Devo, 40% GEPQ, and just 20% QYLD. Why? Devo and GEPQ have proven they can deliver both income and growth, while QYLD is purely for yield enhancement. This allocation would have delivered better total returns while still maintaining that high income stream. Given QYLD's underperformance, investors might consider overweighting Devo and GPQ while maintaining a smaller QYLD allocation purely for yield enhancement. Keep these funds in tax-advantaged accounts whenever possible. Your IRA or 401k is perfect for this strategy since you won't get hit with those unfavorable tax rates on the distributions. Account type optimization should prioritize tax-advantaged vehicles for JEPQ and QYLD, while DIVO's more favorable tax characteristics and superior performance may warrant placement in taxable accounts. And please don't put your entire portfolio into this approach. This should be your income bucket, not your entire investment strategy. Consider it as a replacement for bonds in your allocation, not your total equity exposure. The bottom line is this. Retiring on dividends with just $528,000 is mathematically possible with this three-fund approach. But success depends on smart implementation and realistic expectations. You're not going to get rich quick, but you might just get rich slowly while collecting steady income along the way. The 2025 data shows us that not all high-yield strategies are created equal. Active management and selective approaches like DIVO and JEPQ are outperforming systematic strategies like QYLD. The market is rewarding intelligence over mechanical rules. The strategy remains suitable for income-focused investors who prioritize current cash flow over maximum capital appreciation. Though recent performance data suggests that active management and selective implementation can significantly improve outcomes. Given the substantial assets under management across all three funds, totaling $43.9 billion combined, and their continued institutional support, the approach merits consideration within broader retirement income planning frameworks, albeit with realistic expectations about performance variation among components. What do you think? Is a guaranteed 9.47% yield worth potentially missing out on growth during bull markets? Let me know in the comments. And if you found this analysis helpful, smash that like button and subscribe for more deep dives into real investment strategies with real data. I'll see you in the next one. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching!